In the 1600s, sending a ship across the world was an incredible gamble. Storms routinely swallowed vessels whole, pirates intercepted cargo, and a single failed voyage could see a merchant's entire fortune erased overnight. Equipping these expeditions required a massive amount of upfront capital. Between building the ships, hiring the crews, and securing the trade goods, the price tag was far too heavy for any individual to carry alone. To solve this, the Dutch East India Company factionalized ownership. They sold thousands of small shares to the public, distributing the massive financial burden of a single voyage across an entire population of investors. This map traces early global trade networks. As ownership spread across the public, those new investors desperately needed a way to measure the sheer scale of the danger spanning these multi-continent routes. This shift established the primary challenge for the modern investor, determining if a venture can withstand years of uncertainty before it ever pays a dividend. Modern investors evaluate corporate durability rather than seaworthiness, but the core question of survivability is identical. Imagine two modern businesses. Company A generates 500 crore rupees in operating profit. It keeps its debt very low and holds large cash reserves. This bar chart shows Company B generating a vastly superior 700 crore rupees in operating profit, but it carries a massive load of debt to achieve that size. Most beginners look at that top-line revenue and immediately choose Company B. They confuse the sheer speed of growth with actual resilience. To see what is holding up Company B's massive size, we have to look past the income statement and examine the balance sheet. This visual scale demonstrates the debt-to-equity ratio. This metric measures exactly how heavily a business relies on borrowed money compared to its own shareholder funds. For Company A, small debt divided by equity gives a safe ratio of 0.2. But look at Company B. Dividing its 2,500 crore debt by the same amount of equity results in a ratio of 2.5. The business is overwhelmingly dependent on leverage. Leverage accelerates growth when times are good, but it also creates massive, mandatory payments. The bank expects its interest check on time, regardless of whether business conditions suddenly turn sour. Professional investors use a specific mathematical formula to locate a company's exact breaking point. It's called the interest coverage ratio. This flow diagram breaks down the calculation. We take earnings before interest and taxes, or EBIT, and divide it by the annual interest expense. Company A earns 500 crore rupees and pays 50 crore rupees in interest. That leaves a massive safety net of 10. Now apply that to Company B. They earn 700 crore rupees, but they owe 350 crore rupees in interest. Their coverage ratio drops to exactly 2. Company B has virtually no room for error. Even a slight dip in future profits will consume whatever cash is left and immediately trigger serious financial stress. You might see Company B trading at a lower price-to-earnings ratio, say an 8 compared to Company A's 22, and assume it's a bargain. Rock-bottom valuations are rarely a gift. They often reflect the market pricing in deep fear over looming debt crises and unstable operations. This split screen illustrates a crucial distinction. Accounting profit on an income statement is entirely different from the actual cash entering the business. Company B might legally report a 700 crore profit while only generating 100 crore rupees in real cash because customers are delaying their payments and unsold inventory is piling up in warehouses. Businesses survive on actual cash, not accounting estimates. When low cash generation meets high interest payments, a company loses the ability to fund its own operations, making it entirely dependent on the mercy of its lenders. The true test comes when the economic environment shifts. The cycle of cheap money eventually ends, and interest rates rise. In easy times, fragile companies survive because rolling over their debt is cheap. But when rates jump, refinancing those loans becomes prohibitively expensive. Company A can easily absorb the higher borrowing costs. Company B is suddenly paralyzed, unable to cover the massive fixed obligations it took on to fuel its rapid expansion. Tightening conditions force the market to rapidly reprice risk, and the illusion of debt-fueled growth shatters. People naturally assume that massive corporate size guarantees safety, But giant companies rarely die because their revenue vanishes overnight. They fail because their fixed obligations crush their flexibility, leaving them unable to adapt to harsh conditions. The stock market is a continuous sorting mechanism. Its primary job is to separate the resilient entities from the fragile ones. Returns only matter if the business makes it to the end of the year. Understanding the balance sheet is the only reliable way to know if a company is built to endure the storm.